The 10-year US Treasury yield rose 5 basis points on September 27 to 4.61%, which is the highest level seen since 2007. It has been hovering around the mark since then and has climbed again on 2nd October. The uptick has left traders worried about inflation and a possibility of more rate hikes by the Fed in the near future. 2 weeks ago, Fed indicated that the interest rates would continue to rise and will remain elevated for a prolonged period. This is concerning not only for investors in the US but also for traders in India. I will tell you why. Hello and welcome, I'm Pallavi Sharma and you are watching MoneyWise with ET Now. Let's begin. First, what is the 10-year Treasury yield? The 10-year Treasury yield represents the return that the government offers to investors who purchase the 10-year note, which is a government-issued bond. This yield is important because it is an indicator of investor confidence in the market. Investor confidence and Treasury yield go hand in hand. Prices of 10-year bonds fall when investor confidence is high. This causes a raise in yields. When the investor confidence is low, then the bond prices rise, causing yields to fall. These 10-year bonds are considered to be safe as US has never defaulted on its debt. So in times of raising interest rates and high inflation, the bond yield is higher. All in all, when the prices of the 10-year bonds fall, the yield is up, which spells a greater risk because investors are selling bonds. This also impacts the stock market. When bond yields rise significantly, surpassing the results from stocks, people start to invest more in bonds instead of investing more in risky asset classes like stocks and ETFs. So there is a shift in fund flows from equities to debt. Hence, the relationship between yields and stock market prices is inversely proportional. Now, how will it impact India? The global funds may pull out money from Indian securities or bonds, which means the foreign portfolio investors or FPIs will start moving money out of Indian debt market as investments will become more attractive in the US. To prevent this, RBI will have to raise interest rates in India. Next, the stock market. Indian equities came under pressure today. The Sensex and Nifty both opened lower amid negative global cues and concerns over inflation. High interest rate is also a concern in the US and the raising yields has led to the markets in red. The next question is, will the yields raise further? Well, worries about a potential government shutdown in the US had also surfaced last week. However, the short-term funding will keep the government running till November. This led investors to sell safe haven treasuries. Wall Street also weighed the outlook for the economy and the monetary policy after Friday's release of Personal Consumption Expenditures Price Index, which came lower than anticipated for the August month. Fed's announcement about the further rate hikes indicating a rise in inflation may also fuel the raising yields. However, investors will be looking forward to more economic reports and comments from the Fed this week for fresh hints about the state of the economy. For more such videos, keep following ET Now.
If you like this video, then like, share and subscribe to ET Now.